We made it, Jason. We made it. It didn't look like it was going to come together in the end there. I don't think people realize how much sheer panic there is in the 3 minutes leading up to this show. But we're here. Welcome, everyone, to the Pirates of Finance. The handsome man next to me is the one we all know and love as the young Hemingway. I'm going to keep saying that until I make it stick. I'm Corey Hoffstein. We're your hosts. This is the show where nobody's keeping score but me. We talk about anything and everything finance related. And really, we don't even know what we're going to talk about today. I've thought of the first topic sort of like 2 minutes before I sat down. So I'm just going to hit you with it, Jason, because it's top of mind for me today. And it actually makes me, I think I know your answer, but I'm curious as to what you'll say. Do you think... Oh, actually, before I do this, I have to remind everyone. Sorry, I'm a little scattered. There's some personal stuff going on in my house right now that, like, I probably shouldn't be here, but we're just going to try to get through this. This is not financial advice. Do not take this as financial advice. If you're considering taking this as financial advice, find the big red X in the top of your window and shut it down. Come back when you're ready to take this not as financial advice. This is just two guys chopping it up on a Friday afternoon or whenever you happen to be listening to this, because I guess we're now streaming on podcast platforms, which is great. Thank you, Jason and Tyler, for setting that up. Okay, with that out of the way, here's the starting question for you, Jason. Do you think there's anything in the world that you are either one of the foremost experts on or one of the foremost most knowledgeable people about?
One of the top four? Absolutely not. I was actually thinking when you were giving the disclaimer, I was like, is anybody takes financial advice of two guys dressed like twinsies in matching sweaters, dude? That should be your first.
Guys who are more interested in talking about piracy and rum.
Top four in the world? No, absolutely not. I adhere to the
it doesn't have to be top four, just foremost. Like you're in the
top foremost. Okay.
Top 0.1 percentile or something like that.
Okay, good question. Also, by the way, in your defense, we do actually log on like 15, 20 minutes before and everything's running smoothly. It's just always the last 60 seconds where it all falls apart.
Well, it's the last 60 seconds when you go, hey, Corey, have you tried changing cables? And I go, that's a good idea 60 seconds before the show's supposed to start. And then I can't find the cable. And then I unplug my camera and the camera just stops working. So that's where
yours is still glitching. Even are you on your web? Like you're on your actual computer cam now and not on the Elgato?
I'm on the Elgato, which is the El Glitcho, as I'm referring to it.
I ordered a new one the other day, so now my cemetery cameras is going to have 4 in it now. But going back to your question, so I always thought about the what is it, Scott Adams from Dilbert, right? That idea of like if you're top 10 to 20% in one thing, and then you combine it with something totally tangential in your top 10, 20%, and then especially if you can combine it with the third thing, you become one of the best in the world at it just by default, because you've narrowed down that funnel, that niche. So there's not a lot of competitors in that space. What has actually surprised me, you're really like either. It's such an ego play to even talk about this, man. It's like but I have two competing voices in my head right now. It's like, you suck, and the other one's like, no, you're great. You tell them you're good. But the one that has surprised me more than anything else is over the last few years, as I've been in more of these rooms with elite hedge fund managers, more speaking on stage with hedge fund managers, etc., is how few people at a really top level work on portfolio construction and capital efficiency. And that's what has really surprised me. I mean, I think also we never planned on it, but my partner and I became like the nexus of kind of the long ball space, because we track that the 30 to 40 managers in the space, we allocate to, over a dozen of them. And, so I have institutions and pensions and endowments calling me up all the time to talk about long ball space, because I understand the overarching space better than anybody else. Like, I'm not going to in the weeds of a specific trader like a Ben Eifert of the world. Ben's going to run circles around. But when we talk about the different strategies, the different approaches, and how to combine them, I think there's few people in the world besides my partner and I that could really express, what that industry looks like. So when I think about that, it comes down to portfolio construction, long ball. I think we're right up there. The other one I think is just absolutely BSing on a mic when you go live on a Friday. I think we got to be somewhere in the rankings.
It's a tougher skill than people think, especially for two guys I think that are probably more introverted. Well, I always think about there's a comic I saw a long time ago. I think it might have been XKCD, though I've never been able to re-find it. And it's this idea of like education and higher education and someone going to get their PhD. And it's like this zoomed in picture of a person just pushing against a wall. And it's talking about as you focus and focus and focus, you're just trying to make this dent in the universe. And your PhD, you're trying to work on something novel, right? And if you go into a research field after that, right, you literally are trying to discover new things. But the way the world's gone, you've gotten hyper specialized into specific topics. And so this comic basically has a person like pushing the wall, like creating an indent in the wall, right? And the person is so happy. And then you zoom way out and it's like this big circle of human knowledge. And it's like the tiniest little microscopic like bump out. And I always think about that because, as you know, my obsession in portfolio construction, my quixotic, I don't know, journey around rebalance timing luck. And this came up for me today because I did yet another tweet about rebalance timing luck, because
this is on my list today. I'm glad you're bringing it up.
Well, and there may be those who have no idea what this is. So I'll give a really brief explanation. It has been something that I have researched deeply for the last several years. I think there's only 3 published papers on the topic, and I've published 2 of them, right? So it either means like nobody cares, which is probably the case, or like this is like the undiscovered realm of which like I am just trying to turn into a thing. But so what is it? The whole idea of rebalance timing luck is you have an investment approach or strategy that you are holding fixed. So consider it some sort of like systematic strategy. And you have also chosen a rebalance schedule. So call it annual or quarterly. And the question is, what would happen if you were to adjust the dates on which you actually applied that? So instead of at the end of every quarter rebalancing your portfolio, what if you did it in the second month of every quarter? You're still rebalancing your portfolio quarterly, but it's at a different point in time. And how sensitive is your realized performance to that small change? And when you start to think about it, you can easily go to extremes and say, well, let's say you're building a value portfolio and you decide to rebalance every December versus someone who applies the exact same value criteria but rebalances every June, and you both do it once a year. You would presume that from time to time, you would pick very different stocks, right? What is value at that point in time, despite the fact you can have an identical process and an identical holding period of 1 year. So rebalance timing luck is all about the dispersion in returns. And what I was highlighting this week on Twitter was that JP Morgan actually has this very popular hedged equity strategy. Very simple explanation is they buy a downside put spread and they sell an upside call to make it a quote unquote zero cost collar. And it's become a very, very large strategy in the order of, I think, of $10 to $15 billion. And they do that quarterly, and they decided that they were going to launch a second and third version, one that rebalances the first month of the quarter, one that rebalances the second month of the quarter, to complement their existing one that rebalances on the third month of the quarter. And I think the total return dispersion year to date between these 3 strategies, despite the fact they're identical in how they're trying to be implemented, is 10 percentage points. Right? Which to me is like slam dunk. Like, again, rebalance timing luck is important. If you happen to just choose fund 2 versus fund 3 versus fund 1, you're talking about, thousands of basis points of relative performance that has nothing to do with the core strategy, just simply when did they choose to rebalance. And
that
so,
would have been
of course,
a victory lap for you.
Yeah, this is, I'm only posting things that are a victory lap for me. And yet I post stuff like this and people are still out there like, it doesn't matter. Doesn't matter. And I'm like, I don't know how people can say this doesn't matter. To me, it's like one of the largest drivers of dispersion and terminal wealth that exists in a portfolio that's completely uncompensated. And yet every index in the world completely ignores it. Every smart beta ETF completely ignores it. I have people tell me it's not worth implementing the fix for. And again, I have been talking about this, I think, for 8 or 9 years. I might be going on a decade since I started writing about this, and nothing has changed. In fact, the last paper I tried to submit to a journal, I was told that this is not interesting enough to be in a journal. So that's my rant. I'm done.
Things that actually matter for compounding are not interesting to be in a finance journal. What year was it that you first wrote the rebalancing timing luck paper? Do you remember?
I think the original paper I wrote was like 2017, but I will tell you the very first portfolios we started running other people's money back in 2013, we had already fixed how we were going to run our portfolios for this. And we didn't really start blogging, I think, till 2014, 2015. And that's when we started writing about it. So we wrote about it a lot before we actually published a paper in a journal on it.
There's so many things in here. One, I think you and I have definitely discussed. By the way, the other thing, trying to be one of the better people in the world that's even that, because it's Dunning-Kruger, right? That's the issues we're dealing with. And for those that don't know, like Dunning-Kruger fact.
I'm very confident to say I'm one of the foremost experts in the world on this because no one else gives a shit. This is like saying you're like the foremost expert in like some super esoteric thing and then being proud of it. I'm not proud. This is like an obscure obsession I have.
Yeah. But like when we're talking about this topic in general, like Dunning-Kruger is like when you're first learning about a subject, you're so overconfident in your knowledge, but then you go down through this trough of despair and you're coming out the other side. So when we spend a decade on something, we're still now underconfident. That's the other part of Dunning-Kruger. Everybody talks about the overconfident of the novice, but they don't talk as much about the underconfidence of the so-called expert. And I think that's why it's hard for us to even to discuss any of this. But I was also thinking, like, what you and I both
Dunning-Kruger disproven last year? Wasn't the original study disproven? Ironically, I believe there was a whole. Yeah. Okay.
Well, continue. I mean, none at any of these sociological tests are like unreplicatable, but like this curve, it gives us a proxy for something to talk about whether it's true or not, right? The other thing I think that we're both at least take some pride in trying to be good at is trying to take very complex esoteric subjects and express them in a way that is digestible to somebody coming at it for the first time. So I know we both pride ourselves on that. And so one of the ways I think I originally found you was through Rebalancing Timing Luck. And maybe it was in your blogs in like 2015. And to me, it was like, oh my God, a man after my own heart. Like, this is amazing. It was a bromance since then. And part of it was, when you're looking at rebalancing, but people don't think about it as much rebalancing, is like, that's an integral part of your strategy. You're making so many assumptions when it comes to rebalancing. And typically I would prefer like rebalancing bands that we've talked about before, as they start to get out of whack, then you'll rebalance bands. But if then the other form is, a timely rebalance, why are you picking quarterly or annually or monthly? I always looked at like, I want to tranche out weekly. I mean, but and even if you could do daily, but then you start getting transaction costs. So there's trade-offs. There's always shitty trade-offs everywhere. And so I loved what your Rebalancing Timing Luck paper. So I may be one of those only few handful of people. It also reminded me, by the way, I was watching Welcome to Wrexham. Have you started watching that at all yet? Like,
I haven't. It's on my list. I feel like there's so many shows, by the way, that just came out. There's the new. This is really gonna like dox me as a huge fantasy nerd, but there's a new Game of Thrones, which like I'm trying. I know, like everyone, I was very disappointed in the last season, but we're gonna give it a go. The new Lord of the Rings just came out on Amazon, so I'm like, I got that going on. My wife really loves this show called Never Have I Ever. There's this great show called Trying. There's too much content, and I watch TV like one night a week.
Right. Well, hopefully I watch it like just for like falling asleep. But you and I watch such different things. We live two different worlds. But the Welcome to Wrexham is about Ryan Reynolds and Rob McElhenney of Always Sunny, like, are buying a football club in Wales, soccer club, and it's like the 5th division, and they get together. But what I thought was interesting, why I brought it up, is in the initial part, they're talking about they're going to invest millions of dollars into this football club together, and they're like talking over Zoom and everything, and they do it, and they buy the club and everything, and then you find out later Rob and Ryan have never met in real life. And so why I bring that up is, for those that don't know, you and I have been talking weekly for, I don't know, 3 or 4 years. And then we actually finally met in person, like maybe a few months ago.
Yeah.
It's just,
yeah.
But that's the world we live in, especially post COVID, like kind of thing, or COVID. But that's why I brought that up. And that was a lucky coincidence as well. But going back to the Rebalance Timing, like, why it was on my list, I was scrambling to jot down a list 30 seconds before we came on. But one of them was coming from that tweet, though, you sent about Rebalance Timing Luck. What I wanted to know is, you said in one of your tweets that Wes Gray at Alpha Architects disagrees with you. So what's his argument? Like, Steelman, his argument for me, why he doesn't think rebalancing timing luck matters.
Yeah, it's very unfair for me to try to steelman his argument. I will do as best as I can and be as objective as possible. So, and I don't want to put false words in Wes's mouth, but I believe what Wes would say is look, for an individual strategy, this may be true, but if you combine a bunch of individual strategies together that are all subject to rebalance timing luck, and their rebalance timing luck is uncorrelated, then the total rebalance timing luck in the portfolio goes down. So is it worth the brain damage to try to fix in an individual sleeve of the portfolio if, say, you've got a value stock sleeve, a momentum stock sleeve, international, US, and all of those have their own idiosyncratic and uncorrelated rebalance timing luck that, basically diversify each other out. So I think that's part one. Part two, he would say, from an actual implementation perspective, there are considerations around the costs. And here he and I agree to disagree. But, if you are running a strategy and you have to implement more trades, though the trades are smaller, you may have less explicit impact, but you may potentially incur more slippage. And if you happen to trade things that have a per trade booking ticket cost, like trading international stocks, that can actually increase the total transaction costs. And so the question is, that's a known cost. You're now increasing sort of negative trading alpha. How much do you really want to offset the rebalance timing luck? And that's particularly true for smaller funds. If you're running a $50 million ETF and it's got international stocks in it, that is going to have very different economics than if you're running a $2 billion US equity strategy. Finally, he would argue that there are trading relationships that exist when you're running something like an ETF, and it's important to keep your market makers happy. And the more you're changing your custom basket that the market makers are using to create and redeem, the more the market makers are going to be upset with you because it's more work on their end. The more likely they are to quote a wider bid-ask spread, which has actual known trading costs, right? And it's just going to be an overall worse execution experience for clients. And therefore, when you consider all of those things, it's just probably not worth dealing with. Finally, he would also say there's seasonality effects, that if you're going to actually adjust for rebalance timing luck, the way I argue you should, and sort of smooth out your trading over multiple periods, he would say you're missing out on potential seasonality alpha. And so it's all those things combined that he says, when you take the potential alpha from seasonality plus the extra operational costs, operational burden, actual transaction costs, it's not worth it for many strategies to actually implement the fix to rebalance timing luck. And we agree to disagree. I think we've been disagreeing about this for the better part of a decade. Every time I talk about rebalance timing luck, someone tags Wes on Twitter. Wes and I spend 5 tweets. I feel like we have a playbook. Like, we just go back to an old tweet thread that we've done in the past disagreeing. We copy paste and then we're done.
Well, I understand the trading cost argument obviously makes sense. Let's start then with the seasonality argument. And part of that is implicitly any sort of rebalancing has the implicit assumption of mean reversion between the two assets that you're rebalancing. So therefore, do you think that you have to look at those asset classes and how do they trend and or mean revert? But then that begs the question is, what kind of metric are you looking at? And is this seasonality consistent? Is this seasonality happened over the last decade, the last 2 decades, but is it going to happen into the future? How do you know as far as when you should be rebalancing, if you can't know, because that's what a lot of people say is you need longer time horizons for certain asset classes to mean revert, where you may use a shorter time horizon on different asset classes. Is that kind of what you're referring to with the seasonality effects?
So I wouldn't even think about it as mean reversion between asset classes, right? When we talk about rebalancing, often we think asset classes. Think about this as refreshing a factor portfolio. So again, let's go back to, I think,
long short portfolios all the way down.
Yeah, no, we're going to keep it simpler. Think about, for example, just again, we're buying value stocks. And so we're refreshing the portfolio, selling stuff that's now too expensive, buying the new cheap stocks, and we're doing that on a schedule. And there is evidence out there that suggests that certain factors benefit from being refreshed at, say, the end of quarter versus the second month of the quarter or the first month of the quarter, because you're taking advantage of window dressing that's happening from other people. There's also arguments at the asset class level that there are end of quarter rebalancing flows that you can exploit depending on how you trade. And so those sort of seasonality effects, some people have argued that are going to go unharvested if you decide to change your rebalancing schedule. I have made the argument that those rebalancing effects are so small compared to the absolute magnitude of rebalance timing luck that it's just not worth it. And just to be like, I want to be really clear here, because this is obviously this is something that I've spent over a decade thinking about, and I don't always think I do a great job explaining it. So the way I would explain it to someone is like, and why is this a big deal? Well, imagine I asked you to randomly pick 50 stocks from the S&P 500 and equal weight them. And then the person next to you is going to pick another random 50 stocks, and I'm going to pick 50 random stocks, and Jason's going to pick random 50 stocks, and we're all just going to hold them for the next year. Well, we probably all have a very similar realized volatility in our portfolios, right? But where we end up, the total return we end up with at the end of the year is likely to be very different. So when we adjust for rebalance timing luck, it's sort of like saying, again, we're not fixing the vol in the portfolio. We're fixing that dispersion in terminal results. Now, rebalance timing luck isn't about doing everything at the same time. But my point is, like, if I'm buying a value portfolio in January and Jason's buying a value portfolio in December, right? It's sort of like we're buying completely different baskets of stocks. And even though it's with the same process, that sort of result ends up being the same, that we probably have the same vol, we probably have similar characteristics, we just end up with very different results. And that's not intended, right, by the process.
This is my favorite part. That's actually what I was going to bring us back to, because it's within your paper of rebalancing timing luck and the idea of luck. And this is what I find really interesting. And that lately I've been talking about, we use fancy words like reducing signal to noise ratio, but what we're really doing is trying to reduce luck. Like when I build portfolios, I wanted to reduce the luckiness of my portfolio. And what I find interesting is everybody else wants the opposite. As you know, I was on our mutual homie Meb's podcast this week, and I think this part might have been cut. I don't know. But we were talking about, everybody just loves to gamble. Everybody loves the heroes trade. Everybody wants to be smart, and everybody's trying to get lucky with their portfolios. And maybe you and I agree too much on this, is we're trying to reduce the luck of our portfolios. And everybody's kind of banking on that luck. But then when it comes back to, is like you said, is like, maybe, and like it's unfair for us to speak about Wes or anybody else in this example, but we're using Wes as a proxy. Is when you're saying it may not, the cost may outweigh the benefits, or you're not sure, or the benefits might only slide over the cost. The way I look at it, and I'm curious your take on this, is like, take Kelly criterion. If you use Kelly fractional betting versus like just fixed or buy and hold, it's usually going to take like 500 iterations till you see Kelly start to really outperform, and then it dramatically outperforms. So even if you or I may only have 300 to 700 iterations over our lifetime of our fund, it's still the right thing to do. And so that's the way I look at it.
Yeah, this is something that was very obvious to me early in my career, because I was heavily involved in the tactical space. And rebalance timing luck blew up a number of tactical managers. And so a very simple example would be, if you were, well, let's use March 2020, and let's use Meb, because he just brought him up. Meb's famous, 10-month moving average that he wrote the paper about, that he uses as a timing signal, right? And there's nothing wrong with the 10-month moving average, but it's not particularly magic versus a 9-month or an 11-month. And applying it at end of month shouldn't be more magic than applying it mid-month, right? But if you applied it end of month, February 2020, it said go to cash, and you would have sat out all of March 2020. But if you did mid-month and you decided to look at it middle of February, you would have stayed in the market, and then you would have gone to cash at the very bottom in March. And so the point I'm trying to make is there was nothing about, well, there might be arguments why there was certain seasonality to what happened with COVID. But if you sort of say this was an exogenous event that hit markets, like, it's not like the COVID virus was like, we're going to come in at the end of February. Like, it didn't care about the calendar. Like, we are applying the calendar. And if it's an arbitrary decision, you're inviting that uncertainty into your process because it's arbitrary, right? Now, we can argue about where there are certain gamma effects of OPEX that, sure, we can argue about that sort of stuff. But my broad point is, like, when these things unfold in the market, like, are very arbitrary to the human calendar we've largely decided to apply to measuring market returns, which makes it sort of dangerous to do things on a calendar basis.
Does it drive you just as crazy? It drives me crazy is that we're always providing, monthly returns and annual returns. And you're like, just every time it's like, why do we stick to this just random number that we're choosing a random time horizon? Do you need to go?
Hold on one second.
For those of you, Corey may have to jump at any time during this podcast. So I'm constantly monitoring, where he's at, what he's doing. And otherwise, we may get cut short because I know nobody in the audience wants to listen to me blabber on by myself for an additional half hour plus.
Okay, we're
good.
Back.
Are we good? You sure?
We're gonna stick it through.
All right.
We're gonna. I've got my eye on my phone.
We interrupt this regularly scheduled programming.
Sorry, you were saying.
I was asking you. Oh yeah, like it sounded like you just get just as frustrated I do. It's like, why am I providing you monthly numbers? Why am I providing you annual numbers? Like this is just arbitrary. But it's the conventions that it's pragmatism is what we all work under. It doesn't really make any sense.
Yeah, there's no getting out of it. I have tried to argue for years. In fact, I went a long time without writing quarterly commentaries because I said this is more harm than good. And the reality is, there's just such an expectation built into the industry that going against it, like you just have to adhere to it, right? I think Adam Butler, our friend at Resolve, he talks about this all the time with like what multipolar traps and like it's sort of like when you have someone who's doing worst behavior. It sort of forces everyone to do worse behavior. And so I don't know, someone started doing quarterly commentaries and we all can't get away from it now. So it's a tough one.
Have you ever read Jaron Lanier's like You Are Not a Robot or You Are Not a Computer? I can't remember the exact title, but it's about he was a forefront researcher in like AI and all those things, but he talks about those locked in effects, like whether it's a QWERTY keyboard or certain software that underlies a lot of programs, whether it's like music online or whatever. It's like we get locked into these things and then we build that bricolage on top of them. It's impossible to undo, even though maybe it's not the best solution.
Yes. I haven't read it, but I think that's spot on. And it's made worse when there's the opportunity. I think in our industry, for example, like you and I would say you shouldn't ever look at a back test. Like researchers can maybe do a back test, but you shouldn't market a back test. And yet you have people out there marketing back tests. And so you either have to then try to take the high road and educate an allocator as to why they shouldn't be looking at back tests, but it just doesn't work. Right. And so then you go, okay, well, now I have to show a back test. But if you do a reasonable back test, it's always going to look worse than someone's over optimized back test. So now you have to explain why the other person's doing something wrong, which makes you just sound petty. Right. There's no winning. Like, so part of me just says the SEC should just come down and not allow back tests. But the entire last decade, by the way, the proliferation of ETFs, everyone says it was about, tax advantages. And I think that's true. But I think a huge part of it is because the index providers realized, right, and the ETF sponsors realized that by having a separation between the ETF and the index provider could go out there and show a back test for all these factor strategies. And then the ETF sponsor could just say they're tracking the index and no one was violating any sort of regulatory code. And so we saw this massive proliferation of back tests of systematic equity strategies over the 2010s that honestly, I think quants did a major disservice to ourselves. We backed ourselves into a corner because we allowed our research to be used for marketing, and there's no coming back from that. Because then the whole point of being quantitative is like also evolving your process, and none of that was communicated to buyers. And so they go, what do you mean this low vol strategy that just buys the 100 lowest vol stocks in the S&P isn't your best thinking? And you're like, well, maybe that was a little naive. Maybe we should do something a little more advanced. Like, whoa. You show me this back test that was the best possible thing you could come up with. And it's a mess. It's honestly the number of quants I talk to right now that are trying to undo the damage that we did as a community in the 2010s right now and explain that just like active, quant is an evolving process and a learning process. And quant is more about just the way we implement and do research and doesn't mean we're 100% static in our process. It's a re-education process.
Man, you just put us deep in the weeds of the lunatic fringe of like also about like when I agree with you, like back tests are almost irrelevant. At best they're like a rough intuition pump, but more importantly you actually need to talk to the manager about the logic to what they're doing, and that's what matters, because as a walk forward basis you have red queen principle like you're alluding to and everything. And like I like to make fun of people on your side of the industry and those quants, especially in ETFs and 40x, is like you're basically just the poor crisp data, you guys are just torturing it ad nauseum, like, and you're just they're trying to, and some are disingenuously, like you said, showing proper back tests after they've tortured the crisp data 6 ways from Sunday. Hopefully they're all not doing that, but like this is a problem in our industry that, like you said, nobody talks about. And part of that, other issues that maybe we'll unearth from the industry, like you brought up before, is like transaction costs are one thing, but also like making your market makers happy. Like I just rolled my eyes, but like this is part of doing business. And what I'm always trying to highlight for retail or non-fund managers is that the amount of trade-offs that we have to and hoops we have to jump through to create products, we don't get to put our A+ game, our 100% game forward. It's always shitty trade-offs all the way down, and you're just trying to build the best product you can, given all these shitty trade-offs from the regulators to every side of the, everybody involved. And it's just like entrepreneurship. You're the pragmatism of like trying to build the best product given the constraints you have is the way it is. And I think sometimes maybe people, and maybe I'm unjustly categorizing people as a monolith of naivete, but like I think they think we are able to do whatever we want, and we simply aren't. Like it's so limited what we're actually able to build.
I mean, the number of people that reach out to me that say, "Oh, I wish you would build this fund," and it'll be a combination of a bunch of equity factors and bond exposure overlaid with managed futures that they want me to release as an ETF. I'm like, first of all, like you don't understand the operational complexity of getting it out there. Second of all, no one would actually buy that fund, right? And the example I always use is I say, look, I want you to go look at the international equity space, the US equity space, compare the assets in those two buckets, and then go compare it to global equity. No one allocates the global equity. I don't know why, but people just like to build their US equity sleeve. They like to build their international equity sleeve. And this is the conversation I've had with you, which is we've debated many times. Like the advisor community, at least in my experience, does not buy multi-asset products. The advisor community tends to like to build the asset allocation themselves, which means they need everything in a neat slice. And so once you start blending slices together, you either just get tossed into the alternative bucket, or you better have unbelievable performance for them to justify allocating to you. But like you go look at asset allocation ETFs that are out there, the assets are de minimis compared to the space. No one buys them because that's not how people actually build portfolios. You could build the best single turnkey fund, and you want to know what? No one's putting 100% of their money in it because it just feels weird.
Speaking of which, let's see that we were we weren't beating him up, Wes as a proxy, but we should have like Wes on to debate you instead of me, because I'm just going to agree with you for the most part. But shout out to Alpha Architects and that whole team who we're big fans of. But like they had another essay called like, if God was a hedge fund manager, he'd get fired. And the idea was basically like you'd buy Amazon, ride it into a 92% drawdown, and still end up ahead of everybody over the next decade, but you've been fired as a hedge fund manager. And so that's part of it too. It's like you're saying you can't be weird. And then the other, as you and I are always questioning everything, is like, what's the null hypothesis? Hypothesis. Ugh, I can't even speak today. Hippopotamus is like Buffett, for example. Buffett's fantastic, but what if Buffett was born in Argentina? Never heard of him. Like it's just like, and so that's what you and I are constantly like struggling with is like, and so part of it, I was going to ask you too, part of that rebalancing tranches and the timing costs are weekly and offsetting with the trading costs. Do you think sometimes that the best of both worlds for that is like you do have to maybe use a little bit of rebalancing bands, and that's how you maybe reduce those costs, and you do more percentage bands than you do necessarily timing bands?
Well, one of the things I always point out, at least, and again, it depends on the structure, but with a mutual fund, for example, once the fund gets to a certain size, like you're constantly getting inflow and outflow that you have to trade. So if you have to trade it anyway, you might as well trade towards the position you want to be in, right? And I think that sometimes goes overlooked. It's a little harder with ETFs because you'd have to change your basket, and that's Wes's point, that changing that basket annoys the market makers. Not always been my experience, but we'll agree to disagree on that. Rebalance bands are interesting because you would say, well, And what does that mean? Well, I'm going to allow a certain amount of turnover in my portfolio before I trigger a change. Oh, there's a lot of shouting in my house. There's a certain amount of turnover that I'm going to allow before I trigger a change. I'm not going to do it on a schedule. So let's say I've got a 60-40 portfolio. I may allow it to drift to a 55-45. I may allow it to drift up to a 65-35. And if it just stays within those bands for 2 years, I'm just never touching it, right? But once it hits that band, I rebalance either all the way back or halfway back, depending on how you sort of read the literature. And the interesting thing about that is that strategy in and of itself is actually not, is actually subject to its own rebalance timing luck, which might seem counterintuitive, but let's say you and I both do that, right? And I decide to launch my portfolio on December 31st last year, and you decide to launch the portfolio on June 30th this year. Well, you started at a 60-40 at a point, my portfolio's already drifted. And so the actual where we are relative to the rebalancing bands is going to be different. And so our rebalancing bands will start triggering at different times.
Right.
And so it's actually the rebalancing timing luck is now entirely driven by when did you launch the portfolio. And so even that is not totally like non-susceptible to rebalance timing luck.
Well, and it's not also when you launch a portfolio, and this actually will tie it back around hopefully too. It's like the idea of, I'm going to get yellow flag because I'm going to bring up a yellow card because I'm going to bring up ergodicity, right? It's sequencing risk and sequencing luck as well. So it's not only when you start the fund, it's also each individual investor, when do they come into the fund?
Right. Yes.
And for you and I, the rebalancing and removing the timing luck helps that individual investor also get the ensemble average. But if people aren't rebalancing over frequently, then the individual investor will have a very different path dependency than the average investor in that fund. So that's another way where you and I are trying to help with that, I think.
I should point out, by the way, that if what you're rebalancing over has extreme enough moves to hit your bands, our strategies can converge. So for example, if we're both doing a 60-40 portfolio and we started at different times and then March 2020 comes around, we're both going to end up on the same schedule after that, and all of the rebalance timing luck will disappear between our portfolios. So there can be convergence at the extreme if those extremes are hit, but there's certain strategies for which that convergence is actually going to be far more rare, than like, let's say, value portfolios that might turn over more continuously than having these big extreme jumps necessarily.
Right. And then what you also brought up as far as your inflows and outflows, and I think we talked about this in Path versus Terminus on the previous episode, is like, once again, I would prefer rebalancing bands and everything, but we use monthly rebalancing because we offer monthly liquidity and we have inflows and outflows. So it's like a forced rebalance because, once again, the trade-offs of building an actual business, these are the constraints that we have to deal with. The other, by the way, the other one that the constraints that we have to deal with, because I know we were alerted to some of the comments here, is like, we also cannot publicly talk about anybody else's funds. So I think that also frustrates a lot of people on Twitter as well. Like a lot of the questions we get on Twitter, I wonder if people always think we're like ducking and dodging, trying not to answer questions or be evasive. It's like, we just, from a regulatory perspective, we just can't answer those questions. Like, that's just not possible.
It's interesting. Like it's easier for me to answer those questions. I think it's harder for you because you allocate to other people's, and I do as well. So as a model manager, I actually can talk about other people's funds. I can't talk about my own funds. I can talk about other people's funds, and I should. It's best practice for me to disclose when I personally or my firm allocates to those funds, right? So it's like that is sort of the correct behavior in my understanding of the regulations.
But isn't there
just generally, by the way, you just need to disclose. Like, when in doubt, disclose.
But I don't know if this counts on both sides, like, because we're under different regulatory bodies. But part of it too is you can't give individual advice that you wouldn't give collective advice for, or something like. There's something like that too. Like, or you can't give collective advice that you get individually different. Like, that's because you have to, like, if you take a person's situation, like, you can't give specific advice, but you can give blanket advice.
Yeah, that sounds right. I deal with that less because I don't deal with individuals. And my marketing, using air quotes there, is I try to be like generic research educational, right? And again, like, there's a new marketing rule coming out from the SEC that goes into implementation in a month and a half or 2 months that is changing a lot of these rules. And I believe there's like going to be a very distinct difference between what is considered product marketing and what is considered research. In research, they have sort of a wider birth for. Like you just can do more stuff. You can show back tests. But I think a lot of like back tests in product materials is now going to get kicked out by the SEC is my understanding. I haven't, my CCO is doing a much deeper dive on this than I've done. He's going to debrief me hopefully in the next week or two. But we should see some pretty meaningful changes to the way people are marketing product going forward based on this new marketing rule.
Got it. And then this actually helps us transition while I still got you here, because this is related, is you had Kevin Cole on Flirting with Models podcast and talking about all the different models they run and everything. But what you addressed on there is, I was hoping eventually we get to this on one of the episodes, is the latest AQR paper about pure trend following. And you guys, if I recall, you guys talked about it on the podcast as well. But once again, it's like, what do you think, first of all, about Cliff's contention that that trend following has a dual mandate?
So let's say what did Cliff say first of all, right? Cliff's dual mandate was, one, positive expected returns over the long run, right? And two, to ideally provide some sort of crisis return during meaningful equity drawdowns. Do you think, agree, disagree? Those are the two things he said. I haven't read it in 2-3 weeks.
Yep.
I think that is the expectation for a lot of allocators. I don't know whether it's the right expectation, right? That crisis risk offset was sold hard post 2008, and I'm not sure I'm really comfortable with it. If I just take a big step back and think about, there's sort of two things I think about. One, the portfolio construction itself, like what is trend following? It's basically risk parity, where you have taken, I don't know, it's like taking all the assets of risk parity and buying straddles instead of buying the exposures. Not perfectly, like there's a lot of like look back nature to it, but it's sort of like, okay, I'm taking the risk parity allocation framework. So I've got not 60-40 to all my reply guys, stocks, bonds, currencies, commodities, risk weighting the exposures. And then instead of buying the futures, I'm just buying a straddle on the futures. And so if it goes down, I make money. If it goes up, I make money, and I'm paying some sort of premium. With trend following, that premiums are whipsaw. So do I think that necessarily has to do well during an equity drawdown? Well, there's this great paper, and we might have even spoken about this, and I really feel bad. I think the firm that wrote it is CFM. It's a firm from Europe, and I'm really blanking on this, but they did this great paper that said, look, the more, let's assume like we know we want to hedge equity losses, and let's start introducing random contracts. So we have a managed future strategy that's just 10 contracts, or is it 20 contracts, or is it 40 contracts randomly selected from all the global futures markets. And what you find is that the more diversification you have, the less perfect of an offset it is, versus if you were just, say, explicitly trend following equity alone. And that's because your portfolio becomes more and more uncorrelated to equities. You're holding bonds, you're holding commodities, you're holding currencies, not all of which are necessarily going to respond with any sort of trend during an equity drawdown. Like there's nothing that says commodities have to go up in a trend or down in a trend, or some currencies have to go up in a trend or down in a trend when equities are selling off. And so you're taking meaningful basis risk there, right? And so I don't like it being sold as something like put protection when there's a huge chunk of basis risk, path-dependent basis risk.
Yeah, the whole crisis alpha moniker never made sense to me, because like if it had like 2008, it got lucky in Q4 with being long bonds. Like there's a lot of luck involved. As far as, once again, this is why I bring it up in the sense of rebalancing timing luck. And yeah, you need instruments to trend and be volatile for you to even take advantage, and you need those to overlay at the same time you have drawdowns in S&P 500 or other global indices. The other one, though, like being absolute return, I mean, I think that CTAs and CTA trend followers have a good argument for absolute return. I mean, that's the kind of argument they've always had to make. But what I think was interesting about the article is the idea of do you do pure trend? Do you do long-term trend? What's your look back, right? What are all the different heuristics and implementations and assumptions you're making into your strategy? But then to me, a lot of times these arguments, because we're always talking about shitty trade-offs, is like, yeah, Cliff may be right in the absolute sense. And he may be right in the sense that if it's a capital allocator that truly understands different markets and can stack in different strategies in a capital efficient manner, they can hold this like high octane trend following. But as we've seen, most people are going to cut it out of their portfolio during the 2010s, and they didn't have it in their portfolio coming into 2021 and 2022. And so the argument on the other side is, I think almost like Kevin was making, is like by kind of reducing that variance a little through implementing multiple strategies, or maybe 100 different pods or strategies within there, you at least make it palatable so people will actually hold it. So they'll have some of that convexity for whenever, you know, trends start to manifest themselves again, and you get that higher, hopefully higher beta to inflation.
Yeah. So let me take this another direction, which is one of the things I think a lot about as an asset allocator, as a asset manager, is my job, right, is to ideally generate excess returns above my benchmark. But part of that is making sure that that can actually be delivered by the allocator community, and that they're able to hold on to whatever return stream I'm generating, right? It doesn't help if my return stream is so weird that they bail, right? And never realize, and in fact, perhaps do worse. So for me, it's important that like the advisors that allocate to my strategies, for example, my strategy should not make their lives harder and making sure that their investors stick the plan, right? Because if the investor can't stick to the plan, it means I'm getting fired anyway. So like, I can't be too weird. And so one of the things that comes to mind for me here is like these absolute return multi-strategy portfolios. I think it's a question of like, what does that return profile ultimately look like? Like, let's say you've got a high Sharpe multi-strategy absolute return portfolio, and it's just like going to clip along at 5% a year because you can only do so much leverage. Well, until the new 18F4 rule, you could only do so much leverage in a mutual fund, right? Okay, 5% a year is really attractive, but so are people going to sell bonds to allocate that? And how comfortable are they going to be putting 20% of their portfolio in that? If you're an end retail investor you have an advisor that's put you in this portfolio and you barely understand what stocks and bonds are, and now you got 20% in your portfolio in this global systematic strategy that has hundreds of alphas that you don't even understand at all. Like, is that something you can really stick with? Versus they put 5% into a super high octane managed futures that can be up 50% in a year like this, right? Is that more tolerable? And so I'm sympathetic to both arguments. I would always argue more diversification is better, but at a certain point, you need to use leverage to unlock the benefits of diversification. I'm sorry to ramble, but there was an email exchange I was having with an advisor today who was saying, I have a whole bucket for clients that's like my long-term growth bucket that right now is 100% equities, and I want to do it in a better risk-balanced way. I said, here's the fundamental problem. If you want to do it in a better risk-balanced way between, say, stocks, bonds, and managed futures, you need to apply like 300% leverage. And there's no way your clients are going to let you do that. This is why everyone ends up in 100% stocks, because it has 14 vol, 12 to 16 vol, right? And they're not willing to apply the leverage necessary to get a more diversified portfolio up to that risk level. I've completely lost your sound. And you got the green light on your mic too. I don't know what's going on. Maybe it's me. Tyler, are you hearing Jason?
I might have been
back. You're back.
Can you hear me now? Is there a way to mute it on the mic? I think maybe. Can you hear me? Good.
Yeah, you're back. You're good.
One of the things I was going to bring up is part of the other discussion I think you had with Kevin is something that you and I have talked about a lot about publicly, and probably even more privately, is the pod shops, right? If they have all these uncorrelated strategies, and you guys talk about what's alpha, you and I have argued, does alpha actually exist? All those sorts of things. And to you, like you're saying, like those pod shops, Millennium, Balyasny et al., like they are actually producing alpha, and that's how they're getting those return streams, but also they're reducing that signal noise ratio across all these uncorrelated strategies. But this is maybe a new way I've asked you before, though, is you looked at those, but almost like you set them aside and said, like, those are in a different category and we can't compete with those. But my question is, like, shouldn't that be the North Star that we're all trying to compete with?
When you say I set them aside, like,
it was like almost like you just like, yeah, it was like, maybe I'm wrong, but I felt like, this might come out of some of our other conversations. And it's not just you. I'm using you as a proxy for other people I've talked to about that. It's like, they go, yeah, like these pod traps like Balyasny Millennium is like, those are fantastic and everything, but like I can't do that. Therefore, I don't compete with them. And to me, it's like we're all competing with them.
We're not all competing with them, in my opinion, because 99%
right.
of the mass affluent money will never be able to allocate to those strategies because they're massively capacity constrained, right? The alpha is there and you have hundreds of different little pods because each alpha opportunity can only take so much capacity. And that's sort of the fundamental problem, right? And so, yes, we should all be competing with them, but we're also working within a framework where I have to deliver a packaged vehicle that has regulatory oversight that only gives me, like, I can't just decide suddenly on a whim in a mutual fund with a written prospectus that I suddenly want to start shorting options. Like if my prospectus says I'm long vol and I don't go short options, like it requires me to rewrite a prospectus. And and people are adverse to prospectuses that are too loose. And by the way, even just because I want to do it, it might take me 6 to 9 months to get the paperwork together for me to be able to trade certain things. I can't just suddenly start trading stuff if I don't have an ISDA, right? Like there's real operational burden getting some of this stuff up and running in time. And then it's a question of capacity, right? We go back to like ETFs have to be high capacity strategies. Mutual funds, for the most part, you want to be generally high capacity strategies. And then you have the fundamental problem of needing to sell them into advisors who then need to explain them to clients. And it's just like what we're trying to achieve, I think, in the vast majority of the asset management world. Of course, we want to provide alpha. Of course, we want to provide positive excess returns, but is making sure that we're delivering exposures that we think are beneficial to the end investor over the long run and are able to be implemented by the advisor in a way the advisor can understand and communicate to the end investor. And that's a huge part of the business of asset management. It's the unsexy side of what we do. And as much time as I spend on investment management and research and thinking about portfolio construction and different signals we can incorporate into picking stocks better or rolling our options in a more timely manner or managing our futures exposure better, I spend equal, if not more time thinking about how to communicate this stuff with advisors and how it's going to fit in their portfolio and the portfolio impact it's going to have.
Man, I accidentally teed you up for that one. Like just clip that and then just send that off to you. Like that was perfect. I want to change directions on you, and I shouldn't probably do this publicly. I always
can I pause you for a second? I know I've been talking a lot. How in the world I had full reign of this episode at the beginning? How did you flip this around on me again? You're so good at this.
You know what it is? It's simple. It's another form of Dunning-Kruger's. Everybody loves talking about themselves. So I just keep asking questions and allow you to talk. Everybody likes to hear themselves talk until you realize, wait, what's going on here?
Flattery will get you everywhere with me. Okay.
Yeah, it's inception. So I will, to really balance it out, I'll just embarrass myself. So I always privately am texting you or calling you with crazy ideas. And so I probably shouldn't talk about them publicly, but I was thinking about this inchoate idea. So realize it's not fully fleshed out. But when I always think about politics, to me, politics are just like soap operas for rich old white men. Like a soap opera, like it never changes week to week. You can kind of keep the through line, and it's something they watch every day, and they get to yell at their TV. Like it's just soap operas. The other one I was thinking though, as Jackson Hole happened, and we had Powell's comments and everything, is then trying to listen to these podcasts and read all these reports of what happened. I was like, oh my God, global macro is just gossip for old rich white men. And we're just talking about gossip. So like I don't understand the point. Like it's just gossip.
No, well, I'm sure there's a lot of people who trade macro that are furious with you right now. So thank you. But it brought up something. What you just said brings up something interesting for me this morning, where jobs report came out, and then the number of people that suddenly said this is a Goldilocks job report. Like I just heard Goldilocks, like just across all channels. And I'm like, did that start somewhere? Was there one person who called it Goldilocks and everyone just decided to say it was Goldilocks? Is there like an agreed upon what makes this Goldilocks? Like, and why did and I get where Goldilocks comes from, right? But I think it's sort of interesting that, like, again, the macro channel has its own narratives and what therefore the implications are of, oh, this is like actually soft landing material and trying to forecast the path of the way this economy is going to go, or what this one particular jobs report means for the next Fed meeting. Like, when by the way, you look at the history of predictions and forecasts and they're miserable. They're miserable.
Yeah, well, you know what, actually, to put a finer point on it, what it came out of was I was trying to listen to the Odd Lots with Neil Kashkari. And it literally, like, I was walking around listening to it and I was like, not a single one of like these statements could get like latch onto my brain. It couldn't anchor to my brain because I was like, this is just one person's opinion. And this is just gossip that they're talking about. And it's just like, this is just one of the Fed board of governors. Like, it's just one person's opinion, and an opinion is another form of gossip. And it's just all noise all the time. And I'm just like, why do people take this gossip so importantly? Because I guess it's financial markets. So therefore this is like a life or death thing.
Yeah. All right. Now I'm going to change the subject on you.
Great.
I like that though. I like that. I'm sure we're going to annoy a lot of people with that comment. You, again, I've said this in the past, you consume more content and media than anyone I know. You send me so much and I can barely keep up with it. In fact, I don't keep up with it. I really do try though. What was the most interesting thing you listened to this week?
Oh, man, you're going to really put me on the spot, aren't you?
I think I know what it is. I think the problem is you've listened to so much this week you can't even remember.
Right. That's why I should take notes. I want to hear what you have to say. But actually, one of the ones I was going to bring up is I actually reread or re-listened to Let My People Go Surfing by Yvonne Chouinard from Patagonia. If you've never read that, that's a phenomenal book, just to like really think through the process of building a company. But what do you think is the most, because it probably texted you after I listened to stuff. So it's probably better to ask you what I thought was interesting.
Well, I thought you were going to say, just because maybe it annoyed you, was Patrick O'Shaughnessy interviewing the guy who does the Founders podcast. And for those of you who don't know who Patrick O'Shaughnessy is, or the Founders podcast, so Patrick O'Shaughnessy is the CEO of O'Shaughnessy Asset Management, host of the podcast Invest Like the Best, one of the largest finance podcasts out there. And he has started a podcast platform called Join Colossus. And I tweeted out this week and I stand by it. I fully believe Patrick is on a path to make Join Colossus one of the largest financial media empires over the next 15 years. He has started to acquire podcasts and very high quality podcasts, and he is using his platform to then connect them all. So you can go read a transcript of one podcast and get connected to another independent podcast, but covering the same topic. And so he's solving a lot of the curation as to what podcasts you should listen to. And then he's solving a lot of like the learning and sharing of that information. And I think it's going to have incredibly powerful network effects within sort of the medium. And I wouldn't be surprised if video gets added in the next couple of years. But this is one of those, like, you can sort of see where this is going and there's no way to compete with it. Like, in my opinion, he's got a huge edge because he's a massive podcaster himself and he's built the reputation, and that reputation I think is a big moat for him. And it's like, all right, well played, Patrick. Like, you win this round. Like, we'll see you in 10 years when you sell this thing for $100 million.
So yeah, to clarify, my annoyance is not with Patrick or any of that stuff, but like, yeah, once again, shout out to Founders Podcast and David Senra. So I'm actually really happy for David that he got on. And so like, it's really built his audience even larger. Like, Founders Podcast is one of my favorites. This is one of the ones I highlight and recommend to everybody privately, to other entrepreneurs, because as you're going through the vicissitudes of being an entrepreneur and you have those ups and downs, it's great every week to hear historical representations of what other people went through to remind you this is part of the course. And that's why Founders is one of my favorite podcasts. But what was even better about it is because of this relationship with Colossus or whatever, David has decided to make the public no longer behind a paywall and not subscription only, with ad supported. So more people, so it makes it easier to share. Because that's the hard thing. It's like, I haven't been able to share these episodes of Founders with you because they're behind a paywall. And so it's going to make it a lot easier to share. The part of this annoying, like what you're saying, is like, you know, Inside Baseball is like, we kind of built Pirates of Finance with the idea of like, let's get all of our other friends to come on board too. And let's just like build kind of a podcast network, think kind of like all things comedy, where we're trying to rising tide lifts all boats. And then for you and I, it goes back a long history, is a long time ago when Kyla Scanlon was like first coming out, we were trying to like work with Kyla and everything. And then the Oshags like kind of stole her away for a while too. So it's like, it's more about us just being the small fish. So it's just, we're super jelly that they have the balance sheet and the ability and the team to build this all out when you and I are trying to like grind it from the ground up.
Well, it's brilliant to watch though. And I give Patrick a lot of credit because his podcast is something he did build from the ground up, and it'll be one of those overnight successes, right? That people will go, wow, this, and you go back and I think the turning point for him was he did this series called Hash Power back in 2017 that took his podcast from, if you watch who the guests were, it was like people you and I know and interact with a lot. And it's me in particular, like in the quantitative asset management space or the ETF space, he had a lot of like the people I know. And then he did this huge Bitcoin crypto sort of series. And all of a sudden he was jettisoned into sort of the VC world and the crypto world. And he started doing a lot more on private investments, which I think is really where his passion is. O'Shaughnessy is a public asset management firm, not public in that they trade, but they trade public equities. I don't think that's where his heart really is. His father started the firm. I think he really loves the private investment side, and that's really where his passion lies. And you can see that in the interviews. That's who he really prefers to interview. And so I give him a ton of credit, right? He did a brilliant job taking what he sort of inherited with O'Shaughnessy and turning it into a tech firm. Again, I don't personally like agree that the tech is as valuable as the world has put a price on it, but good for him for selling that firm. And then I think he's going to do unbelievably with this platform. And so it's great to watch him as an operator, you know, to really carve out his own niche after inheriting a business from his father. In many ways, he's able to prove himself and just say, look, I can do this. I can build it from the ground up. And you have to appreciate an entrepreneur that does that.
Absolutely. You and I talk a lot privately about multi-generational entrepreneurship and the things that we deal with both our fathers and grandfathers, and how do you navigate that. But we're getting to the end of time here. So a few housekeeping things. One is, you know, we're doing our best to not pay attention to comments, even though I know we should, but like, because it's so distracting because they're always so hilarious. But apparently there was a poll done who is more handsome, and I'm cutting it off because I was in the lead apparently. So I must have gotten like 3 votes from my mom. So this is the first time this ever going to happen. I'm going to timestamp that.
Kudos to you, you handsome bastard.
Yeah. And then another question for you. Before, when you were having camera problems, I was talking to Tyler about.
Whoa, you smoked me in this poll.
Oh, I didn't even look at it. Like,
it's a blowout.
I think I saw Metaham said that you were more attractive before you went Canadian.
Fair.
But another one, Tyler, we need your poll on this. Tyler and I were talking before you got on. He said he was installing a bidet on his toilet, and I was like, "Oh, come on!" Like, I would build a house around a Japanese toilet. That's how important they are. Like, it is barbaric that we just mash shit into our ass with paper. Like, who does that? That's disgusting. So what's your call, bidet or no bidet?
I can't say that I've ever sampled the bidet. So I can't make a call.
Game
I can't make a call here.
It's just game changer. The Japanese are so much more civilized than we are. We're just walking around here like Neanderthals. All right. He's Corey Hofstein. You can find him at C Hofstein on Twitter. I'm Jason Buck. You can find me at Jason Mutiny. Another thing we say is investment advice. This is hopefully for entertainment purposes only. We are live every Friday at 3 o'clock Eastern, noon Pacific. Please come back next week. We definitely appreciate it. Shout out to the Booty Crew as always. Make sure you like, subscribe, share with a friend, share with your parents, share with all your loved ones. You know, maybe download it on a disk drive, hand them a disk. You know, let's go old school with this. Otherwise, we appreciate everybody being here, and we will see you next week.